In this video, we're going to take a look at trends. This is going to explain how to trade different types of market trends, or at least how you should be thinking. Now, the first thing you need to understand is there are three ways to describe the market as far as trends are concerned. And that is uptrend, meaning prices are rising over time. That is downtrend. And then there is such thing as a sideways market, sometimes called consolidation, where price simply goes back and forth, where buyers and sellers are consolidating the market, trying to figure out their next move. So uptrend, self-explanatory, price of rising over time, downtrend, self-explanatory, and sideways. So those are the three states the market will be in. It can only be in one of those three states. Now, the biggest problem that most new traders have is that they do not know what time frame dictates what. Well, the reality is this. You go out into the forums, you go out into the websites, and they will talk about the uptrend, the downtrend. We're in an uptrend on the daily, but a downtrend on the weekly, a downtrend on the 4-hour chart, but an uptrend on the 15-minute chart. Generally speaking, the best way to go about finding the trend is to actually start with a high time frame, like daily or even weekly. Well, notice how there's a lot less information on this chart, and it's much easier to determine which direction the market is heading. Sellers are much more in control of Litecoin on the weekly chart. Yes, we had a bounce, but at the end of the day, you can see it was slight compared to what we had been seeing. We started at $150, dropped to $35, bounced to 84-ish, 85-ish, which sounded nice, but then rolled over again to continue this. So that is one way to look at it. And if you go back to the daily, it does tell you the same information. It's just with a lot more candlesticks. So pay attention to what price is doing over the longer term. You are looking to trade with the longer term trend. Yes, you can make a few bucks here and there. In Litecoin here, certainly you could have made money buying. But the reality is you are fighting the overall trend. So what typically is advisable is find out what the longer time frame is. And, this is even more obvious over here. Yes, there were times where we did rise a little bit, but look, it gained that much, but it lost that much to get there. So using a little common sense, you should be looking to sell. That doesn't necessarily mean you sell every time, but you have the weight of the market with you. And typically that means it gives you a little bit more room for error. Now, how do we define trend lines? Again, higher time frame, but one way you can look at it is trend lines. So you can go over here to the line submenu, and it's called trend line. And it is a line that shows where price was being supported or the buyers came in. And you can extend it out. So, for example, Litecoin this entire time was going higher. This trend line shows where buyers were willing to get involved. And even when we did finally break down through it, notice how we broke through it and bounced back above it, broke through it again, and then came back and it had a reaction. That is a trend line. That is the essence of defining the trend. There are other ways, but this is the simplest. Sometimes people like to trade channels, and you can click on parallel channel, and you can draw, the same trend line, and then you drag it up. And what you're doing is you're looking for, in this case, you can see where we hit that, actually broke above it, hit it again, and gained back. So there was a little bit of a parallel channel here. Typically, it's not advisable to trade a parallel channel just simply because why are you trying to fight the overall trend? When you see a move like this, yes, it's overextended, but you have to know that there are people underneath that are willing to buy this. You can see that they never even broke down below the bottom of it. And parallel channel can work in either direction. You can have something like this that drag it up. You can make an argument for a little bit of a parallel channel, maybe not all the way back there, but starting right around here. Again, if you're going to use the parallel channel, you want to use this. You want to use the top. You don't want to use the bottom. The only time you use the bottom of the channel in a downtrend or the top of a channel in an uptrend is possibly taking profits and looking to sell either in the middle if you're aggressive or the top again. Again, though, parallel channels are pretty subjective. It's pretty rare you get a perfect one. So, but it is something that you will see on a lot of charts. Let's take a look at Bitcoin. Now, Bitcoin has basically been falling since the peak in late 17. Now, we've had a nice, huge rally in June of 19, but we have clearly fallen since then. So one of the easiest ways to look at this is just change it to like an area chart. You can see clearly we got a nice rally and then we continued the downtrend. So Bitcoin has been in a downtrend since the bubble peak right around 20,000. Now, obviously there have been time frames or time periods, I should say, where things looked quite a bit better. And you certainly need to keep that in mind. But all things being equal, this is a pretty negative looking chart since the highs. So where have you made the most money? You've made the most money shorting. Unfortunately, a lot of retail traders make the mistake of thinking they need to catch every tick one way or the other. And that is a great way to lose your account because it's very easy to look at this chart. And I could show you an example right here. This is the Bitcoin weekly chart, very negative. And you look at the daily chart and you think, okay, well, it's a little better here. But what happens if you are somebody trying to scalp this chart on the 15-minute? It looks very neutral, right? You think, okay, well, I could have made all of this money. But if you were just patient enough and wait for the longer term trend, it starts to look a lot different. And in fact, it looks as if it's trying to roll over here, even as positive as it looked when I first pulled it up. Hourly chart. See how negative this looks. This comes down to following longer term trends. I cannot stress that enough. Find out what the weekly trend is. You follow right along with it. Now, there are some ways to determine whether the trend is changing, and we'll look into that. We have a video coming up a few down the road that talks about exponential moving average. Quite often that's used to determine trend. And you just want to follow the longer term. You want to wait. If this is a downtrend, Bitcoin gets a little expensive, the sellers come back in. You need to be patient. Cannot stress that enough. In the next video, we'll talk about support and resistance levels. In this video, we'll take a look at one of the most basic aspects of trading, and that is going to be support and resistance. So support and resistance is exactly what it sounds like. It is support for price or resistance to price. So for example, a place where price won't drop below. So that is support there as the market continues to find buyers in this general vicinity, just as this was resistance as the markets kept trying to break above there, but could not actually accomplish that. Now, support and resistance tends to form at large round figures, and as a result, you can use that to your advantage. In order to do this on TradingView, you click on the line tool, the horizontal line tool, and you just place it right on the chart. You can drag from the oval here, and this brings up something a bit interesting. So, as you can see, I can right-click this and go down to the settings, the coordinates. I can make it 240 even, and most of the time you will find that price tends to respect these round numbers, like I said. Now, there is an area that has been supportive, a little bit of a range here, just below 240. And as we broke higher in Ethereum on the daily chart, we finally plunged through it and it offered resistance. You quite often see that. It's market memory. So what I use to illustrate this a lot of times will be the idea of a high rise. So say you got 4 floors here. Floor 1, floor 2, floor 3, floor 4. And if you take the stairs or the elevator up to the second floor, what was once the ceiling now becomes your floor. Just as if you drop from the 4th floor to the 3rd floor, what was once your floor becomes the ceiling. It's kind of the same thing in technical analysis. We go ahead and draw a couple of other lines and you will see that as I draw these out, it becomes apparent that this market, Ethereum, seems to like these levels right around every $40 or so. You can make an argument for these are areas you should be trading from. But quite often what people will do is they'll look for support or resistance in the marketplace on higher time frames and then perhaps drill down to a lower time frame to see how it behaves. That's getting a little ahead of where we're at now, but what this does suggest to you is that markets, in fact, are not random, and they do have little roadmap, kind of like posts and signs. You can think of it as opening up a map, seeing that there are directions, there are turns and twists in the road, very similar here. By simply drawing these 4 lines, you can see how different the market suddenly looks. So, like I said, a lot of times they will tend to appear near a large round number. So you can click on a horizontal tool, a horizontal line tool, and you can drag this bubble until you find several places where price either does or doesn't go above or doesn't go below. So, for example, you can see right here there's obviously some trouble right around the $43 level, and you can see that as price kept trying to get there, it kept running into a lot of issues. You can also make an argument for right around here, this would be basically $85. Again, that's a big figure. You can quite often go into these markets and like I said, you start to see a pattern. So for example, let's see what 75 has to say here and Litecoin. You can see 75 was somewhat important. You can see several times where buyers and sellers came in. There was resistance there. There was support there. There was resistance there, et cetera, et cetera. You can begin to, as you trade markets, you can begin to kind of get a feel for what they tend to like. Okay, so Litecoin here, you can see 70 has had an effect on price. So I'm going to take a wild guess and say that we're probably looking at about $15 intervals or so. So let's try 55. And again, it won't be perfect necessarily. It never really is, but you can start to see that there is a pattern to this. And if you really split hairs, you can talk about, for example, maybe, are we going to be seeing, $5 increments? Well, there's probably a reaction on a short enough time frame. So you don't want to go crazy. What you want to see is something rather obvious. And then you kind of put it around the round number typically. So, for example, this is an area for me that I think shows support several times, resistance several times. It's basically $65. I could also make an argument about the $50 level. You can see certainly there are several reactions. In the next video, we're going to talk about another type of support and resistance based upon Fibonacci. In this video, how to trade Fibonacci retracements and extensions. And the first thing that you need to know is that it is based upon a mathematical sequence discovered in the 12th century by Leonardo Fibonacci. And basically, it is a scenario that looks something like this. You have coinciding numbers where you add the first two, you get the answer to the third one. You add the second and third one, you get the fourth. So it's this plus this equals this, this plus this equals this, this plus this equals this. And without going into deep mathematical conversations, they are all based upon 61.8% or 0.618 is the golden ratio. And there are nautilus, rivers, mountains, peaks, everything that you can think of seems to have this number involved in it as far as measuring it. Now, you can study as much as you want about Fibonacci, but know that as far as finance is concerned, it is something that is widely followed. The idea is that there should be some type of action around a Fibonacci retracement level and or an extension level, and traders look for setups at these areas. Now, there are a lot of debates out there as to whether or not there's any efficacy to this, and the reality is that there are enough people to believe in it that there is something to it. Whether or not there's any mathematical nature to it in markets, that's completely up for debate. The idea is with a retracement that you take a swing low and a swing high, and when it pulls back, you expect it to be at one of these ratios. For example, this might be 61.8% on this, and then you buy. So let's take a look at it in real life. Let's see really how we could have looked at this. So we are looking for swing lows and swing highs. It works in both directions. Again, though, it is somewhat subjective because you have to have everybody agree on what the swing low and the swing high is. You can see this is the Fibonacci retracement tool. So this was a swing low, this was a swing low. So let's take this one and drag it up to the swing high, and then you look and you can see the price basically went down to the 61.8% Fibonacci retracement level. The catch with Fibonacci, though, is it really can't be used by itself. There are some people that simply buy a 50% pullback, which ironically actually isn't a Fibonacci number. It's just that for years, traders have always bought the 50% pullback, so they include it in the tool. It should also be noted that there are multitude of other numbers that you can have. I only have the important ones, the 50, the 61.8, the 38.2%. There are other ones like the 78.6, et cetera, et cetera. But really, those aren't used anywhere near as much. It's these three levels, 38.2, 61.8, and the 50%, that tend to attract the most attention. So you can see that we have a swing low, swing high. We pulled back to just about the 61.8. And in fact, we closed above the 50. So you could say that offered support, I suppose. Here's the thing, though. The reason this works isn't necessarily just because of that. There was obvious resistance there previously. So you can make an argument, did Fib work, or was it the previous resistances now acting as support? The reality is this is a good setup because it's a hammer, which is a very bullish candlestick, and you'll learn about those later, right at the 50% Fibonacci retracement level and the previous resistance level. So you can make an argument either way. That being said, that is one way that you can look at it. you know, what's the difference between Fibonacci and horizontal support and resistance? The reality is, you better hope there's none, because you need one or the other. You can see that the 61.8 held on this bounce back, just to show you that it does cause some attention in both directions. You can see that we had fallen, bounced right up to the 38.2 before going lower, and the euro yen. Again, though, you can't just pick a level and say, okay, I'm going to start buying or selling there. There's a cluster here. There's a shooting star here, bearish candlestick, and you shorted. Again, that's something that you'll learn in the candlestick section, but this all kind of ties together nicely. And even, a big hot mess like Uber, which has been all over the place, you can start to see some semblance of pattern here. You can see right around the 50% Fibonacci retracement level of this big move lower. We did, in fact, see some resistance. Fibonacci is also used for the extension tool, and it's in the same menu. Just choose trend-based Fib extension. So if you remember, this Monero one, the original one, went from there to there. So you click on both of those levels, and then you pull back to the beginning. And what you get is the 50% Fib retrace. But notice that beyond the highs, there is the 100%, and then there's a 1.61 extension. And that is an area that a lot of people will aim for. Again, though, I would draw your attention up here. Makes sense that there would be a little bit of profit taking in that region. The higher you go up the chain, though, the less likely it is to hit. So like the 2.618 level is a very long-term type of move. And to be honest with you, if you're day trading, you're very rarely going to hit 161. But it is something to look at if you're already involved in this move. So say you're here and you've seen a pullback in a nice move. You want to know where the market may be able to go. You can go back to the last swing low and use it. So it's a way to enter kind of late, actually. Fibonacci is not something that you can ignore, because it is something that catches the attention of so many traders. But like I said, you have to kind of take it for what it is. It's just a guideline to where things could happen. You could very easily say, well, swing high to swing low, and look, we're right here at the 50% Fibonacci retracement level in Ripple. But what would be even more impressive is if we were at an area that had been resistance and possibly even support in the past. There's a gap there. Resistance, 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 and resistance. And the 50% Fibonacci retracement level with a very bearish candlestick and an overextended move. You could probably put on other indicators that we'll be looking at in the next few videos to give you yet another reason to short Ripple at that level. So again, don't get too hung up on Fibonacci, but do realize that it gives you an opportunity to look for places where people are going to be trading. And that's really all it is. In the next video, we'll take a look at how to trade exponential moving averages. In this video, I'm taking a look at how to trade exponential moving averages. So a moving average is one of the most common indicators that you will see in technical analysis. And a moving average looks basically like this. It's a squiggly line that goes up and down. And what it is a mathematical equation that's being figured out for you. It's plotting every time there's a candlestick formed. And then it connects it all, so it just looks like a line. And the idea is it gives you the trend. It shows you if perhaps momentum is picking up, that type of thing. So in order to do this, you need to click on indicators and strategies. And you can type in EMA, which moving average exponential. I'm going to put 4 on the chart for the purposes of this video. I'm going to go ahead and click these eyeballs. And on this one, on the EMA, exponential moving average, 9-period based upon the close. Going to change the color to blue. Okay, and you can see that the moving average does in fact go up and down with the average price of the close of the candlestick. Obviously prices are rising here, so you would expect the 9 EMA to rise right along with it. You can also put other moving averages on. So for example, let's go to this next one. Click settings. Change the color to red, make it a little bit more easy to see. Input will change to 20. So this would measure the last 20 candlesticks. It's a little slower, and therefore it gives you a little bit of a longer term outlook. Now, there are a multitude of ways to use moving averages. So, for example, notice that the 20 seems to be offering selling pressure. And then once the market breaks above it, it seems to be offering support. That's known as dynamic support resistance. And you'll see it time and time again. The 20-day, in this case, moving average is one that a lot of people pay attention to. There's also a crossover system, and this is probably one of the oldest trading systems out there. And what happens is one of these moving averages will cross over the other. Obviously the 9, the faster moving one of the two, does the crossing. It drops below the 20, and that's a sell signal. And what that tells you is that momentum for the short term is starting to accelerate to the downside, and the longer term kind of goes right along with it. The idea is that if the faster moving of the two moving averages breaks down below the longer term one, then it is a sell signal, just as this would be a buy signal. Now it's entirely up to you whether or not you do it in the old classic sense where people would literally sell, buy, and then if it crosses again, sell. They were always in the market. There are some ways that you can filter some of the noise. So for example, this cross here, some traders wouldn't have taken that until the two moving averages spread further apart. That shows a divergence, if you will, of speed. Because the moving averages are relatively flat there. That shows that the market is not really going anywhere. But once it did accelerate to the upside, you can see that the moving averages spread out apart. There are a couple of special moving average crossovers, and I'll go ahead and show you those now. In order to see these, we will need the 50-day EMA. I'll go ahead and paint that orange. Let's go ahead and put that on. And then this one will need to be the 200. Make this black. So this is 200 days. So they have something known as the golden cross and the death cross. The death cross is very bearish. Golden cross, as you would expect, would be bullish. And that is a moving average crossover when the 50 crosses over the 200 daily moving average. Specifically, it's just this time frame and just these numbers. Just as the death cross is 50 crossing below the 200. So if you hear those terms, those are exactly what they mean. It doesn't happen on the hourly, it doesn't happen on the weekly, it only happens on the daily. The problem with this, of course, is that it is such a high time frame. They are such large numbers that, as you can see, you may get whipped around in this case, but when it does work, it tends to work for a very long period of time. You would have gotten in back here, and you wouldn't have gotten the exit signal until here. So a pretty long amount of time to get involved. Quite often what people will do is they'll use something like this to confirm, maybe like a breakout or something in this case, some type of candlestick formation, which of course we'll cover those later, to validate that type of setup from a longer term perspective. There are a multitude of different ways you can use this. So let's go ahead and put a couple on this Litecoin chart. So this is a daily chart. So let's use a little higher time frame one. Let's go with 50. We'll make that red. Let's go with black on the 200 on the daily. And this sets up an obvious up and down trend type of situation. You can see that we got a death cross there. And certainly that was a selling opportunity. Again, though, not a big fan of these, just simply because for the most part, they don't work, to be honest with you. You get massive gains or you get stopped out with a loss. It's kind of nowhere in between. That being said, though, when you look at this, you can see that the 200-day EMA did offer a certain amount of resistance and then support. A lot of traders will simply only buy or sell depending on which side of the 200-day EMA price is, or in this case, we've had the golden cross, so that tells you that the 50-day EMA is letting you know that shorter term momentum is to the upside. So then you start to look for buying opportunities. An example might be to use, like a Fibonacci retracement. We've broken to the upside. We've come back to the 50-day EMA. Let's go ahead and put a fib there, and you can see it's right at the 50%. It's between the two moving averages. Price has been caught, and it extends its way higher. We break significantly below the 50-day EMA on this particular day. Could give you a little bit of a heads up as to time to get out. In the next video, we'll take a look at how to trade something called MACD, or Moving Average Convergence Divergence. In this video, we'll take a look at the Moving Average Convergence Divergence, or MACD indicator. First thing we'll do is we'll put that on the chart. So let's go ahead and click on Indicators. Type in MACD, and it'll come up. Make sure you click MACD and not MACD Strategy. And you can see it opens up a separate window underneath. And there's a histogram and a couple moving averages. The histogram measures the spread between the moving averages and whether or not the moving averages are rising and falling. So two moving averages, if you plotted them on the chart, and the parameters that are the standard parameters, they would look exactly the same. It's just basically a way of measuring momentum in its own little window. So how do we use this? Well, there are a multitude of ways that people use MACD. The first is the zero signal line cross here. So you can see there's a measurement from 1,000 to 1,000. Now this will adjust depending on, the range of the instrument. But in this case, in Bitcoin, it's 1,000 to negative 1,000. And every time it crosses the zero line, traders will either be buyers or sellers. That's probably the most straightforward and easiest way to trade MACD. Some people will use crossovers as a signal to get involved. You can see that the moving averages do crossover occasionally. So like a moving average crossover system. The problem you have with this, and it's going to be the same with an actual moving average crossover system, is that in a flat market, you get a lot of false signals. So like this market was going sideways and you got chopped up. You eventually did get some profits, but you took a couple of unnecessary losses in that meantime. So a way to filter that out is typically to aim for high or low crossovers. Ignore these ones, but try to find the ones that are much higher. And then some people will use it as divergence. So oscillators, and this is one of the family of indicators in oscillator. Sometimes what you'll see is prices moving higher, but yet the indicators on the oscillator are not. And what that tells you is that perhaps the underlying momentum is waning. And that is a sign of internal weakness. People will sometimes use the moving averages. Sometimes they'll use the histogram. It really comes down to, how quickly you want it to happen. More often than not, though, you will see the histogram used. So I've got 3 assets. I've got Bitcoin, Canadian dollar, Japanese yen, currency pair, and U.S. steel. Let's go ahead and walk through these and see if there are some, ways we could have used MACD to help us. The most obvious place on this chart is right around here. We had seen a moving average crossover at an extremely high level. And this, of course, was the highs of Bitcoin. So not a huge surprise to see that it failed at that level. It's gotten way overextended. Up to about 14,000, and we have rolled over a bit since then. You can see there was another crossover here. There is a bullish crossover here, but notice how the market itself was relatively flat. So probably not the greatest signal. You can see here, same thing. A bullish crossover. We started swinging up, but the market was drifting a little bit lower. It was just kind of lackluster. Part of the filter can also be how wide the histogram is. You want to see a wider histogram. It makes more sense that it may give you, because it shows a greater diverging of the 2 moving averages, that there's more strength, if you will, in whichever direction. The 0 line crossover right here would have been an excellent buying signal, for example, as well. But with Litecoin, let's take a look at the 4-hour chart, and you can see it works on smaller time frames as well. There's your moving average crossover, and we did in fact drop. Wasn't a huge move, but it did move. Moving average crossover right here led to the market picking up quite a bit until, probably right about here where you would have got a cross signal. So that, of course, set up quite nicely for a potential run. And as a result, it looks as if this has been steady along the way. In the next video, I'll take a look at understanding stop placements and signs of momentum loss. In this video, we'll talk about stop placements and signs of momentum loss. So if you're in a trade, you need to know where it is you want to get out, where things could prove you wrong, or for that matter, where the market is moving against you, even when you are in profit. So let's take a couple really simple ways to look at the market. Let's go ahead and put the volume indicator on. That will give us an idea of momentum. Like this candlestick here, for example, huge volume shot to the upside. So clearly, if you're going to take a trade based upon that, right here at the bottom of this candlestick is a good stop loss. We rallied quite a bit. You can see that there is some support there. That could be your next stop loss. So once the trade moves in your way, and if it breaks back down, then you got out with a small gain. Some traders will do something very simple. Once the trade moves in their way or in their direction, you see this high here, that stop loss. Once we break that high, then you move your stop loss closer to that, and so on. Or on the downside, if you're short up here, maybe based upon this very bearish candlestick, we fell, we pulled back, and then as we cleared this low, confirming a switch in trend, they'll put their stop there. We pulled back, they put their stop there after we broke down. That's a very common way. Of course, you need a trend for that to happen. But there are some other things to pay attention to that are quite obvious. So on the way down, in this massive candlestick here in Monero that broke the whole thing down. So if you were short, maybe you were short because of this trend line break there. That was another reason to sell. Well, if you're short and you see this massive candlestick on massive volume, well, you know that if it gets broken to the upside, something's changed materially in the market. So there hasn't been a whole lot to do over the last couple of weeks in this Monero US dollar pair, because there really hasn't been a huge volume spike, if you will, or anything that's changed the attitude of the market. Yes, it's drifted higher, but on pretty weak and low volume. So that's one way you could look at it. There are also other ways people will do it, like with Fibonacci retracement. You know, notice how the 38.2 is basically the same thing as the top of that candlestick, so that's one thing to keep in mind. You can also use moving averages. So an indicator that you could put in there, see an EMA. Now this is a daily. So let's go ahead and make this, I mean, at the very least, you don't want it to be a 20. And realistically, you probably want it to be a 50. So put your stop right around the same place. And you'll find that sometimes it all kind of lines up at the same area. So I have a Ripple chart pulled up. And there are quite a few different ways to look at volume and the trend. So, for example, if you are already long of Ripple at this point, remember our trend line. This was a nice run from the 16th of March all the way to the 10th of April on the 30-minute chart. So quite frankly, there was no reason to be short of Ripple any time during this. Now, that doesn't necessarily mean that you want to be long the entire time if you're day trading. If you're investing, totally different story. But notice every time we pulled back, and especially when we pulled back close to the trend line, there's where your stops need to be placed. You need to find a place that the market has to do serious work to take you out. You don't put stop losses based upon your account size, meaning like, I'm only going to risk X amount of dollars, but I'm going to put a big position on. That's not how it works. You need to do some money management, figure out your maximum loss to start with, and then you move your stops accordingly to what the market tells you. In the next video, I'll take a look at a couple of very useful and thankfully obvious patterns because it gets other people involved. The double top. In this video, we're going to talk about double tops and double bottoms. And these are simple yet effective ways to look at the marketplace in order to find a potential reversal. These are also known as W and M patterns, and I'll show you why here in a moment. A double top is simply when it sounds like, when price tries to rally to the same place twice, and it ends up forming a top. This is also called an M pattern for obvious reasons. A double bottom is just simply the opposite, which can be thought of sometimes as a W pattern. Markets fall to a specific level, bounce a bit, come back down, find buyers again, and then turns around. Now, it should be noted that it doesn't have to be the exact same price. You're looking for something close. There's no real rule, as it were, like in Forex, you wouldn't say it has to be within 3 pips. Basically, you're just looking for a general double top or double bottom. So let's take a look at a couple of examples. You'll see them all the time. It's very common. But in Bitcoin here on the half-hour chart, you can see that we made a top here. We pulled back, we made a top here, and then we fell. So that is a double top. Now, how do you use this information for your trading? Well, there's a couple different ways you can do that. You can put a sell order at the bottom. That's typically how it's used. And then put a stop loss on the other side. You can do that, or if you want to tighten it up, put your stop loss about halfway through the pattern. You're looking to at least capture the same distance from the top to the bottom, much like a head and shoulders pattern. But a lot of people will even go 2 times, so 2 times the height, especially if it's with the longer term trend. You can see clearly that happened. in Monero, I have an example of a double bottom. And what's particularly telling about this is that it is at an area that had been important previously. It had been in an uptrend, and then we pulled back. So this is even more important because this is a continuation sign. In general, you want to trade with the trend if you can, but these are also important signals that perhaps we're going to get a trend change depending on what's going on. Obviously, you can look at a chart here. You can see how it worked out, but trading in the moment is an entirely different situation. So, for example, at this point, we would have been in an uptrend, so it makes sense that more often than not, this double bottom pattern is going to hold and send the market higher. Just simple observation on the 4-hour chart. As you can see, these double tops and double bottoms offer nice signals. They offer a nice measuring stick. In this video, I've shown a couple of nice little signals here, and there was a nice measuring stick built in, and that's one of the beauties of these patterns. Beyond that, they're very obvious. We have a continuation of the uptrend. If you remember that was the one that we were looking at. Let's go ahead and show. So here's the 20 EMA. Notice how once we filled this out, we had formed this W pattern. We also had broken above the 20 and then used it as support on the move higher. So these are all things that could come into play. Furthermore, there was some recent support there as well at a round number in the form of $80. None of this happens in a vacuum. You can see that I have taken a very basic shape and then I've added a few other things to it. Very basic stuff. This isn't magic. This isn't something that takes a ton of thought or calculation. You just notice that, hey, somebody that is trading support and the 20 EMA both got a signal and we got this W pattern. So there's at least 3 groups of traders that are willing to be involved. Plus, it was already with the trend in this case. So longer-term trend traders would have been paying attention. In the next video, I'll take a look at rectangle tops and bottoms. In this video, I'll be talking about rectangle tops and bottoms. So a rectangle top or bottom is a pattern that, as I'm sure you can guess, is shaped like a rectangle. And what happens is that support and resistance comes into play at the same 2 levels. And then you eventually get a break out of it. And the idea is that in the case of a rectangle top, you're rallying into it and then you break down. It's a reversal. It becomes a rectangle-shaped top to the market. If you are falling and you get a rectangle consolidation area and you break out of it to the upside, it is a rectangle bottom. Pretty straightforward. And they happen on all time frames. So you see them quite a bit. It's just simply consolidation that doesn't lead to continuation, rather a reversal. So let's go ahead and draw a rectangle here in the Litecoin market. Now, how you will trade this is one of 2 ways most of the time. You will either take a measurement, and most people do it this way. You'll take a measurement and you'll aim for the exact same height. So from $80 to $76 is where you're looking at here. Well, 80 minus 76 is $4. So once you break out of 76, you're looking for a move down to 72, something that you clearly hit. However, some traders, with their stop loss over, behind here, adjust this. Now, this is the way you're typically taught, but a lot of traders will, if they have to risk this for this, well, that's a 1-to-1 trade. They don't want that. They want more. So they aim for double. And in this case, clearly you've gotten it. Because remember, you want to risk 1 to gain 2 minimum, preferably 3 or 4. But as this breaks down, they will move their stop loss to break even once you get that 1-to-1, and then they'll let it run. Or they'll just let it run like that. An alternative is to set a stop loss at half the height and then aim for the $4 here, the height of this trade. And that gets you back to 1 risk for $2. Ethereum, you can see that there was a couple of rectangles here on the hourly chart, and you will get them more frequently, obviously, on shorter time frames. But there should be no doubt that those were both profitable trades, because you're only looking for twice the move, or twice the height of the rectangle for the move. Clearly, that was not an issue. You can see that support breaks. The reverse of the recent trend tends to be pretty brutal. And again, you should be able to get twice. In a continuation move, there are already a lot of people on the side of the move, in this case going higher into this. So that would be one reason to think that maybe the momentum isn't going to be as quick. You'll probably be more apt to get the occasional pullback. And now keep in mind, this is on the hourly chart. So, you need to look for quicker moving indicators. You can see we got a crossover here, signal crossover in the MACD on both times. And then by the time we broke down, we were starting to scream towards the zero line. So that would have been something that would have caught your attention. Furthermore, on the second one, this would have been an area where we had seen resistance recently. So you can see how using some of these indicators can give you an idea as to, okay, not only is the pattern setting up, not only have we, in this case, broken through support or broken through resistance on a rectangle bottom, but now you have people who pay attention to MACD paying attention to it, etc., etc. In the next video, I'll be talking about head and shoulders, one of the trading community's favorite patterns. I'll take a look at the head and shoulders pattern. The head and shoulders pattern is one that is recognized by most traders. It's very commonly traded, so of course you want to know about it. A head and shoulders and an inverse head and shoulders, because there's two directions that you can trade it. Looks something like this in the case of a head and shoulders. In an uptrend. So what happens is you get a continuation of the uptrend. You get the pullback like you get, in any uptrend. And then you continue to go higher. You make a higher high. That's part of an uptrend as well. You pull back a bit. And then this hump over here doesn't make a new high. So this is a shoulder. That's a shoulder. And that's your head. Hence the name. You can draw a line from these little dips between the head and shoulders, between each shoulder and head, I should probably phrase it as. And that's your neckline. And your neckline is a signal to either buy or sell. In this case, sell in a head and shoulders. So think about it. What's happened is we've rallied, we continued, and then this time we just ran out of momentum. The great thing about head and shoulders, it's got a built-in measuring stick here where the top of the head to the neckline, if you measure that, and let's just say it's $200. Well, break down at the neckline, you're aiming for at least $200. A lot of times the stop gets put on the other side of the shoulder. And quite often that automatically gives you at least a positive risk to reward ratio, sometimes 2, sometimes 3 to 1 automatically. Another thing that you'll notice over time is a lot of times these patterns, especially in currencies for whatever reason, they'll fulfill that move, grind for a bit, and continue going even further. So that's the head and shoulders. The inverse head and shoulders, as I'm sure you have guessed, is simply the bullish version of this. In a downtrend, you'll see something like that. You've got your neckline, you've got the measurement, you got your target. Should be noted, it can be angled like this. It does not have to be straight up and down 90 degrees, so sometimes, they'll actually look more like this, and then you draw your line like that. Same thing with the inverted head and shoulders. So let's take a look at these in the wild, and you can see exactly what I'm looking for here. And there's your neckline. So you can see that the pattern does play out, right? So here is your neckline, and here is the height of the head to neckline. And you'll notice that we clearly hit the target without too many issues. And in fact, hit that area a couple of times. Not a huge surprise because a lot of times these areas get visited more than once. And finally, over here in Tron, this is a 4-hour chart. You can see that we had been rallying. We got a nice rally there, a bigger rally, and then kind of ran out of steam. Let's go ahead and draw our neckline. You can see that you could have put your stop loss here. Your measured move was 6 cents. So from 21, you're looking for a move down to 15. And you did in fact get it. Wasn't right away, but it did happen. Never threatened your stop loss. You will find that head and shoulders patterns are followed by quite a few traders, mainly because they're obvious. They catch a lot of people's attention. Higher time frames are much more reliable than shorter time frames, as is the case with all technical analysis patterns. Let's take a look at MACD. And you can see that we had a crossover at an extremely high level right here at the top. And then by the time we got down here, we were well below the zero. So that, of course, would have caught the attention of somebody who was a MACD trader. The 20 EMA in a 4-hour chart, you can see sloped nicely, crashed through it, found resistance, and then broke down. That would have been a signal for somebody using the EMA. There are quite a few different ways to do this, but you'll notice that the pattern, the great thing about this pattern is that when you step into it and you get the breakdown, for example, in this case, you knew exactly what you were looking for to begin with. You also had a place to get out because patterns do fail. They're not 100%. But the nice thing about these patterns is so many people pay attention to them that they give you a little higher percentage probability. In the next video, I'll take a look at something called a doji candlestick and the myriad of different types. In this video, we'll take a look at how to trade something known as a doji. And a doji is essentially a neutral candle, although there are various flavors of it. But really what you're looking at is an opening and a close price that is either the same or very close to being the same. This is one of those things where it is a little bit of an art form, because some people will say that it needs to be an exact open and close being the same. Some people will say that, if there's like a tick or two difference, that's fine too. So really at the end of the day though, you should assume that these two mean the same thing because essentially what they do mean is that the market is undecided during that time period. In this case, it would be Litecoin on the daily chart. There are a few other ones. There's a gravestone doji, which means that the market rallied and then broke back down during the day. That's a pretty bearish sign. There is a dragonfly doji, which is somewhat bullish in the sense that it is unchanged, but we did initially try to break down, but the sellers were repudiated. There's the long-legged doji, which just simply is a longer version of a doji. They all mean the same thing, though. They mean indecision. So, really, they are a bit difficult to trade in the sense that they are probably not one of your more reliable candlestick patterns. So you have to add a filter to it. Some people will come in and just say, well, buy or sell dojis. And that's not really the way it works in the real world. For example, what you're looking for is multiple dojis. So I'm going to go down to a 4-hour chart here. And this is an example here. There's 3 dojis in a row. There's something that isn't quite a doji, but it's similar. There's something that isn't quite a doji, but it's similar. But what you're looking for in a scenario like this is you're looking for some type of change in attitude. So as you can see, when I draw these two lines, the dojis kind of spell out the indecision area. So for about 16 hours or so, the market was trading in this little area. So what you want to see is a close below the support or resistance. And in this case, it was the support. And we did, in fact, break down from there. So where do you go looking towards? One of the most obvious places would be previous, in this case, previous support. Had we broke higher, it'd be previous resistance, assuming that you had it. We're not at an all-time high or something. So that's a quick and dirty way to look at this. You can put indicators on to go right along with it. So I'm going to go ahead and put this indicator on. This is the 9 EMA, and you can see that it did break lower on a close lower of this little range. So it makes sense that you continue to go downward. In a sense, this is almost the same as trading a rectangle. But in this case, it isn't a top or a bottom. And essentially that really is what it is. It's the market kind of not really knowing where to go and then eventually making its decision. So let me go ahead and get rid of this and see if I can find some others. They do happen quite a bit. It's not that rare. You could even go so far as to say that it is probably one of the more common setups. Again, though, like I said, it isn't necessarily the most reliable setup. So really, you want to see multiple dojis form. So you can see that the dojis were bouncing off of this area here. This one was probably the most dojiest of doji candles, if you will. And you can see that there was obvious resistance just above, and it's also shown by these wicks. Once we broke out, we went straight to the next potential resistance area and then pulled back. And not a huge move, but it does double this area, much like a rectangle. That would be your minimum, obviously. These do happen time and time again, and you'll notice that once we broke out of this area, the big green candle got support from the 9 EMA. Now, you can trade just a single doji, and some traders do, but the more you get in a row, the more success you'll have as a general rule. Now, again, that's not always going to be the case. You'll notice that we were in a downtrend here in Bitcoin. We rallied a bit. We formed a doji right here where we had seen previous resistance, right at about $7,100. You put a stop loss on the other side, you sell once you break down below it, and you can see it ends up being a nice trade. I'm going to go ahead and put an EMA here, and I'm going to, although you could use a 9, I'm going to use a 20, just because I like the way it behaves on a daily or on a intraday time frame. And you'll notice that there is a doji right here. The market had been rallying a bit, and then it's just kind of hanging here at this moving average. You could also make an argument for a certain amount of support here at, let's just call it 6,600, just to give it a round figure here. It's actually a little bit lower than that, but you can see that the market had been hanging on to this area. The fact that the 20 EMA has come into play formed a little bit of a supportive candlestick here known as a hammer, which will be in our next video. But you can see that we kind of stalled here, and then we broke the top of it and then shot straight up. So all things being equal, you're with the trend over the last several hours, and the fact that we broke the top of the doji suggests that perhaps that indecision has gone away. Another thing that I would point out is that in this particular run, you can see that there is a gravestone doji there, which in theory is very negative. However, it can also be said that once you break above the top of that, that's a certain amount of resistance overcome. So when you look at it, and then here, and the 20 EMA all kind of coming in together at the same time, that does suggest that perhaps there's a little bit more to go here in Bitcoin. In the next video, I'll take a look at two of the most powerful candlesticks out there, the hammer and the. In this video, we're going to take a look at the hammer and the hanging man patterns. These candlesticks look the same. Basically, they look like this, or they can look like this with a small body, but the commonality is short top wick, longer bottom wick. Looks like a mallet on a handle, so therefore it's called a hammer. It's called a hanging man because they say that when that forms, it is a very grave sign. So the difference between the two is where they're placed. A hammer is at the bottom of a downtrend. A hanging man is at the top of an uptrend. The inner workings of what's going on is what's important. You'll notice that the sellers gain a lot of strength during the day or the hour or whatever you're trading, but then the buyers come in and support the market. This shows that the sellers are running out of strength. And this could be a bullish sign at the bottom of a downtrend. However, at the top of an uptrend, there's a few special rules. So let's take a look and I'll kind of show you what I'm thinking here. This is a hammer. This is a downtrend. And you can see that they tried to push lower but failed. So when you break above the top of the hammer, think about all of the sellers during that hour. Now the price has gotten above it. Well, they're all losing money and they need to buy the market to flatten their position out. So essentially, in this case, in Litecoin, you're taking a look at where are all the traders positioned and what are the wrong ones doing? Well, the wrong ones are covering their buying, so price went higher. Notice how this one formed, but it didn't get broken above, and therefore it wasn't a signal. But also notice how the hammer here that got broken above ended up being retested, and then we rallied towards this area. So that's classic behavior. So this is the hammer in question for the Litecoin market. Remember, this one had formed, but it didn't get broken to the upside, so it never really kicked the signal off, so to speak. So the first thing you look for 99.99% of the time is, does it make sense that this candlestick pattern has occurred where it has? I'll move this down to the mid-century mark, 3650, and you can see that there was an explosive move to the upside there. So obviously there are going to be a lot of orders there. So that makes sense. You can also see that there was a lot of volume here as well, but we could not break down. So that makes sense that we might be running out of momentum. Let's go ahead and put our MACD on. And you can see that at this hammer, we had reached extremes, and shortly thereafter, we got the cross, which kicked off the trade. You can also, in this particular instance, look at a set of EMAs, for example. And you can see that the candlesticks had been spreading, right? But notice how the moving averages had been spreading. But notice how we slammed right into this moving average. Now that could have been your initial target. The reality is, though, and this is important to note about moving averages, support and resistance matters much more. So as we pulled back there and then we formed this other hammer, that shows you that the market is okay with testing this. So that would have given you a little bit more confidence going forward. Again, this is a pretty significant candlestick at a pretty significant level. And as I zoom out even further, you can see just how significant it was. So in those cases, you have to be a little bit flexible on how you use these indicators. But without a doubt, the support and resistance, by far the biggest thing. So here, a hanging man is right here. Now, those of you who are particularly astute may go, well, that looks like a dragonfly doji. Well, they're really kind of the same thing. There really isn't a huge difference. It is traded the same way here in the sense that we're in an uptrend, we pull back, we rally, and then we break down. And that is the first sign of support breaking, and we went much lower. You can also make an argument for that being a hanging man. After a quick bounce, we broke down below the bottom of it, the buyers lost momentum again. Stop loss goes on the other side of the candlesticks, pretty straightforward. This is like right in an area that's caused some resistance in the past. You know, we pulled back and then we ended up forming that hourly hanging man. You can also take a look at the MACD. This looks like something that would have suggested that there's probably some momentum problems here. Yeah, you can see we crossed right there and then rolled over. Pretty straightforward. And if that didn't convince you, then obviously the very bearish candlestick that was next certainly should have at that point. So in the next video, we're going to take a look at a pattern called 3 white soldiers and 3 black crows. In this video, we're going to take a look at a pattern called 3 white soldiers and 3 black crows. Now, the reason they're called white soldiers and black crows goes back, it harkens back to the old black and white charts. In modern trading, most charts are red and green, so it would be, something to the effect of, I guess you could say, 3 green soldiers, 3 red crows. Doesn't make as much sense, from a visual standpoint, but that's basically what you're looking at. So really, this is the pattern. It's that simple. Now, the purest pattern will have gaps lower and then they'll rally, a gap lower and then they'll rally. Now, this is an extraordinarily difficult pattern to achieve in most markets, with perhaps the exception being the stock market. So we actually use a variation of this. All we ask is that you dig into the candlestick from the previous candlestick. So, for example, you get a white candlestick and or a green candlestick, and then maybe you continue to go higher, but in the interim, you pull back into it, right? So maybe it looks something like that. And then the next one would be something like this. Now, this basically tells you the same thing. And what it tells you is that buyers are becoming aggressive. 3 candles in a row, the 3 white soldiers pattern, or 3 green soldiers, very bullish, suggesting that you're going to see a pretty big move higher. Typically what you'll do is you'll put your stop loss behind the middle candlestick and you'll buy on the top. Some people will put their stop all the way down the bottom. It really kind of comes down to what you're comfortable with. But for the most part, if you're going to retrace that much of the move, you're going to have a losing trade, so you might as well save some of your cash, right? So with the 3 black crows, as I'm sure you probably have already figured out, it is basically 3 black negative candlesticks, traded the exact same way. You know, you're looking at a scenario where you really are starting to see momentum accelerate to the downside. So let's take a look at this in the real world. Here in Bitcoin, the hourly chart, you can see that we rallied, and then we pulled back, and then we rallied for that hour, and then we pulled back into this hour and then rallied again. So once we broke the top of this, it showed extreme continuation. You could put your stop right there and you can see it just took off. I mean, it was a straight shot higher. So that's a 3 white soldiers or 3 green soldiers setup. And in Litecoin, you get 1, 2, 3 candlesticks in a row. These are black crows. You can break down below the bottom of the candlestick pattern and you can see stop here, stop there, doesn't really matter. It goes all the way down to the $41 level. Now, again, this is a bit of a adjustment for day trading. But if you think about it, it makes perfect sense. If you get expanding volume or expanding range, 3 candlesticks in a row, well, that means something. So that's how, as a day trader, we use this pattern. You can see we had broken through support right here at $45, basically. So that was your first clue. You also could have traded with, perhaps Bollinger Bands, because what you're going to see here is we had broken down that line and started to walk the line. So that's a very strong side to the downside. And you can see that the 20 SMA, simple moving average, was right there. So you know that the 20 exponential is going to be probably just below it. So you were already underneath that to begin with. As you can see, when you zoom way out, there's an argument to be made for this as well, which would be a major symmetrical triangle being broken down. And you did, in fact, get that move all the way down to here. So a lot of different factors setting up in this trade. And with these trades with the indicators, your job is to, when you see the pattern form at support and resistance, you need to find a couple of other reasons to get involved. This is why you should have your support and resistance levels drawn on your chart to begin with, and then the pattern, and then the indicators. And then when you lay all that together, you have confluence. Confluence leads to profit.